Aegon has posted a €206 million net loss for the third quarter, driven mainly by a non-economic loss on rate hedges in the United States. The insurer says savings and growth initiatives have not been enough to mitigate lower fees. Lard Friese is the CEO of Aegon and joins us now. Lard, good morning to you and thanks for giving us your time. Just talk us through then the quarter and the loss and what shareholders should feel about it.
Yes, good morning, and thank you for having me again. Aegon is shifting gears these months. We have announced three major steps in our strategy. The first one is that we have announced that we will combine our Dutch activities with ASR to create a national champion, the number 2 insurance group in the Netherlands. We have also announced today that we have found a path to maximize the value of our high net worth business in Hong Kong and Singapore by entering into an internal reinsurance contract, which allows us to free up 600 million of capital. And in addition, we've also announced today that after ample analysis, we have decided to continue to actively manage the variable annuity book in the United States while taking an additional step to mitigate its risk profile. And all of that against the backdrop of very volatile markets, as we all know, in the third quarter. And today we have posted a solid set of results with a strong balance sheet, with all our capital positions above their operating targets, and with good steps that we were able to make in spite of the inflationary headwinds that we're seeing in our expense reduction program.
So, Lard, there's a lot going on, I think, is clearly the message there. Reuters have got you down as a miss on the operating line here, in spite of what you've said about the solid delivery. And I just come back to the question that I was asking about the rate hedges in the United States that have generated the loss. Can you tell us a little bit more about your market exposure and the potential for any further impairments or losses running into 2023?
These losses you're talking about are non-economic, non-cash, and quite frankly, accounting noise. The reason for that is that we indeed have large hedge programs that we are running to keep our capital positions strong, and that is in fact what has happened, because look at them. They are above their operating targets, which is important for our clients to know that their money is safe with us. The reason behind this is that the assets need to be accounted on a fair value, market value basis, while the liabilities are on locked-in rates, basically on book value. So there's an accounting asymmetry there. Now, as the industry moves at the beginning of next year to a new accounting standard, IFRS 17, this accounting noise will go away. And therefore, we believe it is much better to look at the operating result, because that is a better reflection of how our business is doing overall.
OK, fair enough, and we'll take that as your answer, Lard. In terms of that operating business then, we've spoken to Amanda Blank from Aviva yesterday. We've spoken to a couple of the big reinsurers as well. It seems that everyone's getting a little bit more excited about the premium environment and the fact that the higher cost of money has taken the tourists out. Is that your experience?
Well, what we're seeing, of course, is that inflationary pressures are real. This means that we are seeing inflationary headwinds, but in spite of that, we are able to do a number of things. First of all, we have an expense reduction program. Inflationary headwinds are, of course, a headwind for that, but we are able, in spite of all that, to make good progress. Secondly, we've taken measures. We've hedged, for instance, the balance sheet in the Netherlands to ensure that the inflationary pressures there are basically immunized. And then finally, we make sure that premium increases where we need to do them to pass on the inflationary pressures, that we make sure that we offer the clients flexibility by allowing them to either adjust the coverage, but then against a slightly higher premium, or we allow them to keep the premium levels as they are, but then we need to adjust the coverage somewhat. And by offering that flexibility, we allow in this inflationary environment our premium rates to be competitive, and to ensure that we navigate our clients well through their choices.
And that's a really interesting answer, because you sound, if I can put words, you sound almost apologetic that premiums are going up, whereas no one else I've spoken to in the industry has sounded like you. Everyone's saying, thank goodness, after all these years where we haven't been able to have decent premiums to justify the risk we're taking on. Everyone else seems to be quite excited about it. You seem almost apologetic, Lard.
Absolutely not. We believe that we need to be competitive, but we also need to be customer focused. It is absolutely critical that customers who are seeing a lot of pain coming through because of the inflationary environment, the energy prices, etc., that customers are able to afford the coverage that they have. And therefore, we are reducing our expenses to make sure that we are efficient and competitive in this inflationary environment, and that we offer options to ensure that our clients can navigate appropriately through this.
Lard, I think coming back to the point you were making about the accounting standards changing and how we should understand the mark-to-market versus previous valuations of the book, it just throws up more questions about how companies like yours negotiate the challenging sovereign debt environment going forward. And of course, the situation we've had in the UK over the last month or so has generated some concerns, I think, about liquidity in that space. I wonder if you could comment at all about the environment that you feel we're moving into early next year, and how businesses like yours are going to have to increasingly try to match liabilities through other assets and investments.
Yeah, for long liability players like ourselves, interest rates are obviously key. And to the extent that interest rates become higher as the inflation is being fought by central banks, that is good news for us, because the guarantees and options on our balance sheets are weighing less. Our products become more attractive for customers. And of course, we need to reinvest against higher rates, and that's good news for us. So longer term, higher interest rates are good for Aegon. Now, the situation that we've seen over the last couple of months is that interest rates have shot up very sharply, very quickly. And of course, long liability players need to ensure that all the collateral posting that takes place because of the large hedging programs are done in a good way.
We're going to have to
and
catch
therefore,
up with
liquidity
you.
management is key, and that's what we have to do.
Brilliant. We're going to have to catch up with you for a longer answer on another day. I'm sorry we've run up against the break, but thanks so much for being with us. Good talking with you. Lard Friese, the CEO of Aegon, will